Welcome back to Grow Quality. My name is Elian, and in today's video, we will be taking a look at Monday.com's Q1 24 earnings release. Because they were so much better than analysts expected or investors expected that it made the stock jump 20%. Now, for this video, we will be taking a look at the slides that Monday.com provided to us, but also to some highlights from the shareholder letter. Now, the shareholder letter, of course, is a vertical format, while the presentation is a laying format. So we might see some changes there. And in order to do this in a correct way, I might take myself off of the screen from time to time in order to show what otherwise would be hiding under my frame. Now, let's just dive straight into it, starting with the platform to run the core of all the work. Now, this is, of course, a slide from the presentation, but what does Monday actually do? Let's give a small recap of what the company actually does in order to see, well, why it jumped 20%. So, Monday basically has three products they offer, and that's the work management, the Monday Dev, and the Monday Sales CRM. Now, from the basics, Monday.com is a work management tool, and they are expanding into different products and categories in order to diversify their offering and in order to attract new customers. Now, this is something they have started recently because the Monday Dev and the Sales CRM are quite new products, and you will see that in some later parts of this video. But let's quickly continue because starting off, they gave us a slide update on some improvements or enhancements they made to their platform. So, well, you can read it yourself if you want to, but they improved their safety and they improved their governance. So, there were better settings for governing users and guests on the platforms of a enterprise. This was mostly done for the enterprise level. So then, what did they improve for the work management tool specifically? Well, they created portfolios, and this was done in Q4 23. But the portfolios allow users to automatically link projects to one combined portfolio. Okay, so how much does this add to the platform? Well, it's a nice small slight improvement because users have created more than 15,000 portfolios. Now, that's of course strong participation or strong use of this, well, slight development. And that's of course a positive. It's not a huge positive, but it's just positive to see. Okay, so then we have the breakdown of the Monday Dev platform. And basically, this is also just a work management tool, but it's specifically to developers. It's just geared towards them. And this is where Monday.com sees incredible growth because they grew 44% quarter over quarter. Now, of course, as I already mentioned, this is still a slightly smaller platform. Slightly smaller, this is just a smaller platform. So such growth numbers can be somewhat expected. It's more normal in at this size than at the Work OS size. But still, it's incredible growth, and a lot of it comes through cross selling. So that's also positive. But if they can keep up with this growth numbers for a few quarters, well, that would be great. That it's growing so fast, that's incredible. Now they have another platform that's growing also very fast, but is quite some steps ahead of Monday Dev, and that is the Monday Sales CRM. And here we can see another 27% growth quarter over quarter. They grew to 16, almost 17,000 customers, and they still managed to grow at 27%. So that's quite impressive. Once again, this is also done a lot through cross-selling because they have opened these platforms to all customers now. Now at the bottom we can see some enhancement they made to this platform, such as calendar integration and calls and recording. And I like the way they are doing this because Monday just makes small incremental steps to improve the platform bit by bit by bit by bit. And overall, if they keep adding to it and keep adding to it, they will just, well, it will make the platform a lot and a lot better over time. Just keep adding those small adjustments and a small improvement. It's a strategy I very much like. Don't be pushing for big updates all at once, which are filled with bugs. Just make small adjustments over time and keep adding value to it. This is also what they have done previously, and at the end of last year, they made their first price increase for existing customers, and this also helped somewhat for the revenues, but we will get to there in a minute. So let's continue. Monday also released a new AI capability because Monday didn't really have one. Now, they said they were working on it, but they failed to see a good use case that really added value to their customers. So instead of just pushing some AI thing out there because, well, now we do AI, they only wanted to do something that was really worth it. And I like that. I like that they want to have a good thing first before they push it to their customers. So, what do they have? Now, the capabilities currently include categorization, summarization, text improvement, translation, and sentiment analysis, and they can be used across the entire platform. Now, you can see the details of it below, but let's continue. Okay, so this is where I said I will take myself off of the screen because, of course, there is some data behind where I should be or where I have myself in the frame normally. So what we can see here is from the presentation, of course, and we can see that revenue came out to 217 million, which was 34% year-over-year revenue growth. Of course, that's very good. I mean, it's not that small of a company anymore with such small revenues that's very easily done. They are getting up there because if we look at the right, we can see that they now have a annual run rate of, well, they are getting close to a billion. I mean, one or two more quarters of this growth, and they will be at $1 billion of annual revenue run rate. So that's very good, of course. And they have a 48% year-over-year increase in customers with 50 plus K annual run rate. Now, that's also very good. Net dollar retention for this group was 114%. So that means that on average they are growing the revenues they have with each customer, and that's a positive thing. Now, with the 114%, there is a slight caveat, and I will get to that when we break down the net dollar retention slide. But gross margin was 90%, and they had 90 million of free cash flow in the quarter ending. Now we see two asterisks there, and that is because they say non-GAAP financial measures, see appendix. Okay, so it's non-GAAP. But what we also want to look at is the asterisks below, because there it says, as of the end of Q1 24, note 100% of our revenue is generated by subscriptions. So that's very good. That is what I want to hammer home here. This is very good. They have a subscription business. 100% of revenue is generated by subscriptions, of which 80% is annually and 20% is monthly. Now, these monthly build, they have seen the increases already in price, the price hikes that Monday has been running, and the customers that are billed annually, they will get this in their next contract extension. Okay, so then we continue with the push up market because what we see here is the percentage of annual recurring revenue. And what we can see here is that the customers with 10 plus users, they account for 78% of the ARR. 50 plus ARR customers represent 32% of the total annual recurring revenue. And the customers with 100K ARR are responsible for 20% of it. This number at the higher ends is increasing more and more. We can see at Monday that they start landing bigger and bigger and bigger clients. And that's very good, of course, because they are also the more stable clients, as they say it themselves. Now, with this slide, you see it more clearly because we can see 48% growth at the 50K ARR customers and 55% growth at the 100K ARR customers, while they have 18% year-over-year growth with the 10 plus users. So this means that the larger customers are growing faster. And like I mentioned before, this is very good, but it's also representative of the way Monday tries to sneak into these customers. Because before we go into this slide, it's something I want to explain very quickly. Monday.com tries to sneak into one department or a part of a department or a certain team in order to prove themselves. And if they get in there, they continue to expand. They spread out into the company in order to grow and grow and grow within the company, eventually going up to the C-suite. And when they are there, because that is where they find new ins right now, that's where they land the really big customers. In the Investor Day presentation, they also mentioned they have a new largest customer. And I don't remember the number from the top of my head, but it's a big, big customer. I believe it's something like 50,000 seats or something. That's a huge customer. And they do this because they see that the work they are putting into sneaking into the customer or into the client's businesses and then just spreading out in there is really paying off. Now we can also see that, of course, in the numbers. Now, if we look at to the left, we can see that they present at 43 or 34% year over year growth. And I think that's quite sustainable for some time to come. But they also say that they have annual revenue increases of 65% CAGR. Now, this will not be sustainable. This will come down, of course. But it's very high numbers of growth. Okay, so then let's look at the financial highlights. And what we can see here is, well, first of all, this is another slide taken from the shareholder letter. And why did I do so? Well, that's because they put the GAAP results and the non-GAAP results very easily under each other. Now, there is one difference in these two metrics, and that's stock-based comp. They take stock-based comp out for the non-GAAP results, but for the GAAP results, they have to be added in there. And this alters the results slightly, but let's look at it because we can see revenue growth of 34% and gross profit of 33%. Now, that's not the biggest difference. Then we get the gross margins, which are 89% compared to 90%. Well, again, that's the slight difference in the growth there. Now, R&D expenses increased 20%, sales and marketing 19%, and G&A at 11%. So that means that the overall or the total operating expenses grew by 18%, but gross profit grew by 33%. So that means that they improved margins, well, immense basically, because this is just huge differences. Most of the time you see 2 or 3% differences here. This is like a 15% difference. And that's logical because it's a very rapidly growing business that is really focused on turning a profit. But it's a big difference. It's a really, really big difference. Now, they had an operating loss still of $5 million and an operating margin of negative 2%. And when we look at the non-GAAP results, this is why they take stock-based compensation out of that factor. And here we have operating income of $21.5 million. So basically, they have $26 million of stock-based comp, $26.5 million. Okay, so we will look into that at a later point again. But here also they have a non-GAAP margin of 10%. Now I prefer to look at the GAAP results, but the non-GAAP results are very good and the GAAP results show a big, big improvement. So then we look at this slide because it's a bit more specific, and what stands out here is that they suddenly have a net profit while they had an operating loss. So why is that? Well, the company has right now $1.2 billion in cash with no debt. So what do they do with that cash? They just put it into treasuries, money market funds, and they earn some interest on it. And we can see that here, 12.8 million, which shrinks their operating loss to a net income, of course. Now, they did also decrease that operating loss very significantly. So where they now are profitable based on a, well, net income basis, but not an operational basis, at GAAP level, that is to say, this will swing around in maybe the next 1 or 2 quarters. Because right now they also come to a net income per share of 14 cents. That's very good, of course, because last year it was a net loss or a EPS of minus 31 cents. So when we very quickly go through their balance sheet, we can see this. They now have 1.2245 billion in cash and cash equivalents. The accounts receivable stayed basically flat, and the prepaid expenses were slightly up. Nothing meaningful there. The property and equipment was the same. Operating lease was slightly down, and other long term assets were basically flat. No real spectacular changes here. Of course, the cash increased slightly because they are cash flow positive and they have no debt. So the cash position increases and they just use that cash right now to earn interest. And that's very good for the business. Okay, so then we look at the liability side and they have accounts payable ticking up quite a bit. Now, this is a very low number still, but it is up somewhat. And well, we don't really love to see it. What other parts do we have that stand out here? Nothing really. The liabilities increased slightly, but so did the assets. So, all in all, when we look at the bottom, we can see that total shareholders' equity, well, it increased slightly. Nothing very spectacular, but it's good to see. Okay, so then we have the reconciliation of GAAP to non-GAAP financial information. And this is where I said that I want to show you their share-based compensation expense. Because if we look at the bottom, or a few rows below the bottom actually, we can see that they gave out $26.5 million of stock-based compensation. Now, this is not something I really love to see because it's quite a big percentage of their free cash flow, but it is growing very much slower than they are growing actual free cash flow. Now, over the last 3 quarters, SBC expenses were coming down a bit, and that was better, but they have said that they want to hire more staff, especially sales and R&D people. So they will have some increases in SBC because they just have to pay those people with stock included. Now, once again, this is not ideal because it dilutes my part in the business. But seeing how much cash flow they can bring to the bottom line, at some point they will start to do buybacks. And that's where the fun really starts. But for now, they are just growing very fast and they want to add about 30% headcount this year. Now, this point is further emphasized by the fact that we have here at the top the non-GAAP operational expenses and of course the margin because the non-GAAP margin is 10%, of course. But we can see that sales and marketing make out 56% of their operating income or expense, of course. Now we have 16% in R&D and 8% in general and administrative. Now the 56% of sales and marketing is very much. It's a very large part of their expenses, but it's also quite logical because they are trying to get their foot into the door at as many businesses as possible. They are trying to grow as fast as they can. They are in their hyper growth mode or phase. So they just want to get the foot into the door, but at as many potential customers as possible. And as long as it's working, that's fine. Now, at the bottom part of this slide, we can see the headcount, and they want to increase it by about 30% this year. Their focus will be on R&D, product, and sales teams, but that's also what I already told you. And I think that's fine. They have to improve the product. They have to get the product through the door. Now, these sales teams, they are trying to specialize them for the different platforms they have. So the Work OS, the Monday Dev, and the Monday Sales CRM in order to get their specialists in there. And I really like that. But of course, that will come with some expenses and they just have to get better salespeople in there. Now, finally, we have to look at the guide because we can see that for Q2 24, they are guiding for $226 to $230 million in revenues. So that will be year over year growth of 29 to 31%, and non-GAAP operating income of 17 to 21 million or a 8 to 9% margin. Now, free cash flow will be 47 to 51 million at a free cash flow margin of 21 to 22%. This is, of course, very healthy, very good growth. The free cash flow margin will come down from this quarter. That's not really that important. It The important part is over the long run for the entire year. And when we look at the entire year, we can see that they are guiding for $942 to $948 million in revenue, year-over-year growth of 29 to 30%, and a non-GAAP operating income of $77 to $83 million. This is also a 8 to 9% margin. And they want free cash flows of 238 to 244 million, or a free cash flow margin of 25 to 26%. These are very good guidances, because, like I said at the beginning, Monday jumped 20% after releasing their earnings. And that's of course a huge jump. But then again, we have to remember that the stock was somewhat depressed. Now, at the current valuations of Monday, I don't know if we can really say that they have a depressed share price, but it went down from about 220 or even 240 at the top to about $180. This was due, in my opinion, for a large part with worries over the Israel economy, because they are an Israeli company. That's something you have to keep in mind with what's going on right now over there. But they beat all the guidance expectations. They guided above, well, their low end of the guide was above the expectations of the guide from analysts. And the same thing goes for the full year guidance. So that's a very good thing, of course. And with that, I want to end this video right here. If you want to get more updates from me, I have a website where I push a newsletter where I give my opinion about stuff that is happening in the markets. Now, I am very much focused on tech and growth. That's where I will mostly comment on. But besides just the comments on either articles or things that happen to stocks, I will also write some articles which will go into some more specific and more extended materials. So if that is something that interests you, the link for my website is in the description down below. Make sure to check it out. And also like and subscribe this video if you have enjoyed it. And with that being said, thank you for watching.